Hi, everyone, and welcome once again to Business and Banking Dialogue. Over millennia, the way credit looks, feels, and is used has changed dramatically. Okay, credit has always been there, right from olden times, in some form or other. But the times have changed and things have changed dramatically. Today, buoyed by a plethora of technologies and a golden age for abundant data, credit is undergoing its most radical change yet. In the beginning, credit was highly personal and subjective. This persisted for thousands of years, So he is my so-and-so, he is so-and-so, and that's how lending used to happen. Over the last century, a miracle happened, driven mostly by statistical modeling. Credit became, for the first time, objective. Yet, today, the cracks in that system are beginning to show, and we are now on the brink of another, perhaps a revolution in credit lending. We are on the verge of an exponential leap, and I think exciting times ahead of us. Like we heard yesterday, this virus has a lot of problems, but it's also opened up a lot of opportunities. So people will think differently, will do differently, will act differently. So credit lending will also undergo a change. So, ladies and gentlemen, today's topic of discussion is of interest to all of us. To discuss on the future of credit, our subject matter expert is none other than Mr. Udayan Goyal. Good morning and welcome to the Banking and Business Dialogue Show.
Hey, good morning. Good morning, KK. How are you?
I'm good, sir. Thank you very much, Udayan. So, Udayan, today is a very special day for us. We are on the next lap of having had a non-stop 50 online shows already. So today is the 51st show. So Udayan, you have been a contributor to our success, tremendous contributor to our success. A big thanks to you. Any thoughts on the show and our thoughts for the next lap?
I think KK, you made the point. I think it's an interesting time. This virus has not only redefined many business models, but has created lots of new opportunities. So often, obviously, the world is largely focused on some of the issues that the virus has created, and of the human tragedy has obviously been enormous. But through any crisis, often comes opportunities that will allow us to progress both as a human race, and below that in terms of the types of businesses we encounter, how we manage our societies, how we think about the future. And I think a lot of that is starting to happen. I think this dialogue is contributing to that discussion. It's contributing to how best to navigate what has been a very difficult situation, and let's get the best out of it. So very interesting.
Thank you, Udayan. So, ladies and gentlemen, welcome to this show on the future of lending, future of credit. I have with me Mr. Udayan Goyal. Many of you may have seen him, but for the first timers in this show, he is the co-founder of Apis and Anthemis Group, which is specializing in global investments in fintech companies. So a warm welcome to all my participants across YouTube, the EPS channel, Twitter, and LinkedIn, and of course, Facebook too. So Udayan, what are the traditional ways of providing access to credit, and what are the limitations of traditional models of providing credit access?
So look, I think let's go back to the history of credit, right? So the history of credit, it almost goes back to the history of banking. As you know, the point banks and financial services companies traditionally are institutions that disintermediate capital. So on the one side, you have capital, and then on the other side, you can provide capital, and there's a cost available to be able to provide that capital. And that's what we consider to be, I guess, the fees and the interest rate that is available to people to borrow that money. So, and this has been around for hundreds of years. We know very well that the Venetians, for example, created quite institutionalized ways of providing credit. But really, the way credit started out, the way we think about it today in the modern age, was around the 1500s, when you had the age of discovery and people started to discover the new continents. Merchants started to sail across seas, and particularly after the Reformation, in England, the first country really in the world to establish a legal rate of interest that sort of came through this was actually England in 1545, during the reign of Henry VIII. And that rate, believe, was actually set at 10% at the time. And that was kind of the beginning of what then became modern credit. So, and it's interesting, as early as 1787, in England, there was a philosopher, Jeremy Bentham, and Jeremy actually wrote a paper called A Defense of Usury, arguing that restrictions on interest rates harmed the ability to raise capital. So this was really the first time, I think, people sort of started to think about market forces being more important than regulatory forces. Quite fascinating when you look back at the history. And in fact, if you look further back at the history, just one other point is, the word bank actually comes from banco, which is bench. And it's actually comes from Venice, where the moneylenders, or the people who used to provide credit, used to sit on a bench and next to each other and do the deals. And that's where the word bank comes from. So, and even the birth of the modern consumer credit, credit reporting itself originated in England in the 19th century. The earliest available account of this was a group of English tailors that came together that just really swap information on customers who failed to settle their debts. So this was the first concept of a credit bureau, right? Where people started to put down, people who haven't paid and sort of blacklisted them. And then you had many societies to be formed, like the Manchester Guardian Society. In New York, there was a society called the Mercantile Agency in 1841. So and that the Mercantile Agency itself became R.G. Dunn, and R.G. Dunn is actually one which is now done in Bradstreet, is one of the big global credit agencies. So you can go all the way back many hundreds of years to see how this has come through. And so credit has really been, as you know, one of the lifebloods of most economies. You need to disintermediate capital in order to allow growth to happen. And so it's become a very important part of how you create growth in economies in various countries. This is extremely important. This is the way we allow companies to grow. We allow people to leverage themselves and to allow capital to go that much further. And without it, I think we would have significant issues. Now, what has been the game changer in credit? And the game changer, of course, is what is the basis of credit? The basis of credit is actually data. It's the way we use data. And the basis on making a credit decision, or whether we should lend money to people, is all about the data that you have on people. So the more data you have, the more granular the data, the more relevant the data, the better a decision you can make around credit. And so fundamentally, as you realize that we're moving into a world of big data, and obviously that is going to have very significant consequences in credit infrastructure and the way we think about credit.
Excellent. Thanks, Udayan, for giving us a background. And so like ladies and gentlemen, like Mr. Udayan Goyal has been talking about, credit, has been there for years and years and years, hundreds of years ago. But over the period of time, it has evolved. And today, data is the decision maker for all credits that you get. It's not about knowing somebody. It's all about data that's out there. And so that has kind of changed the way lending is happening in our society. And there's still a lot of transformation happening. So we will have, in the course of our discussion today, we will know what else is happening. So traditional credit scoring has not been able to address the market needs effectively. How would alternative data help to evolve credit scoring, address the unmet or the undeserved or the underprivileged demand for credit?
So look, traditional credit decisioning and traditional credit analytics, let's use the right terminology, has largely relied on two things, right? One is being static data. So the data needed to be collected. So let's go back, I don't know, 50 years, and you used to have to walk into your bank. The
Yeah.
banker would sit down with you and take down a lot of information on a sheet of paper,
Yeah.
and collect as much data as they could. Then they would try and use other sources to validate that data. So let's say your salary. So how would they validate your salary? They would say, provide me your pay slip. Then if
Yes.
they wanted to do a second level of validation, they'd ring up your employer and say, is this pay slip correct? So you'd go through all those validation processes. This is the kind of traditional way data can come in. Now, Kiki, you talk about alternative data. Alternative data, it really goes into this concept of the big data infrastructure that we live in today. And as you know, and we've talked about this in previous discussions, there are lots of ways that people provide data into the world that we live in. And one of the biggest ways that's common and known to all of us is social media. So,
Yeah.
for example, Facebook and Twitter and all these other social media means collect massive amounts of data on people. The other big area of data, and it's actually probably the biggest area of collection of data, is actually the use of our mobile phones. Our
Yes.
mobile phones are a rich data source. They're a rich data source because who we call, how we call them, how often we call them, how we use our mobile phones, how much data we consume on our mobile phone, all of these have very striking correlations to people's credit risk, because it's two things. Credit risk is two things. It's one is about your ability to pay, right? Your ability to pay is often set on hard data, which is what's your salary, what do your assets look like, all these things, and your preponderance to pay, i.e., do you want to pay? And that's a lot around behavioral analytics. And the
Yeah.
behavioral analytics, interestingly enough, uh, you can do a much better job on understanding behavioral analytics based on your social data around Facebook and all these other things, based on your mobile data, than you can on your static data on your assets and things like that. And actually, your single biggest factor in terms of whether you default on credit or not is largely related on your behavioral analytics. So it's not your ability to pay which dictates how safe you are as your credit. It's how much you want to repay that loan and how much you want to pay the interest around that loan that actually drives the kind of risk you are. Quite interesting once you start to think about it. So
Yeah.
obviously, there's been a multitude of statistical techniques that have been used to crack this data. Probably the most important statistical technique is essentially looking at correlations between observed credit defaults and
Yeah.
other disparate types of data. For example, how many Facebook likes you have. I'm just using these as examples, but what you need to do is take thousands of different data points, and you need to take a credit curve and you need to map one against the other and see where are the commonalities or where are the correlations. And then
Yeah.
and then you can actually identify the factors. And it actually surprisingly is not many factors. People talk about, there are many sophisticated companies out there who talk about using 50,000 data points and figuring out whether you're good credit. Actually, out of those 50,000 data points, there's probably 10 data points that provide 90% of the insight,
Yeah.
right? And
Yeah.
so you're able to look at that correlation. You're able to refine that correlation, then use that as a technique. Now, this is very profound, and it's very profound for many reasons. One is related to what we talked about last week. For financial inclusion, this is almost a game changer because it allows people with non-traditional credit history or non-traditional data to be able to access credit, which they were not able to do before. And they were
Yeah.
essentially, because even a person who's never taken a loan or never had a bank account, often they'll have a phone and they've used their phone. And so that allows you to use that or they have a Facebook account. It allows you to use that non-traditional data and to build some form of risk analysis on that person. So the other is, and that includes areas like call networks, other data sources. You can have a unique combination of data sets. So the ones that I know of are like who you call, when you call them, what time you call them, the mixed up with how you use your data, what types of sites, your geolocation data. So there's lots of interesting things that you can use to actually build that correlation. And once you built that correlation and you've used those non-traditional sources of data, you can bring in a whole group of people who previously you couldn't assess and you couldn't actually
Yeah.
lend to. So your actual market size becomes enormously bigger than it actually used to exist before. And so there are, of course, ethical considerations, data privacy considerations. We've talked about those
Yeah.
previously. There are regulatory implications around all of this. But fundamentally, the science, the data science, and the ability to use that data today exists in a way that never existed before.
Yeah. Okay. Thanks, Udayan. So, ladies and gentlemen, very interesting times, the way credit is given. So it's not about what you are today. It's also about what are the things you're doing. Okay. So like Mr. Udayan said about data, the data is a game changer. So if you're using a social media, or of course, you're using mobile phones and behavior analytics is being done with the usage of what you do, what's your data like. So it's not about historical data. It's also about what you do today. So, Udayan, are you coming to the point of telling the participants that, you must be careful when you're using your social media and mobile phones, because these are also tracked for building any correlation for in case one of the participants wants to go for take a lending?
Yeah, I think without doubt. I think without doubt, any publicly available data, which by definition will include your social media data, whether or not you've provided consent, and that's a very tricky argument
Yeah.
because you should really theoretically you have to provide consent, but in reality that's a little bit more. A lot of people don't know they've already provided that consent because when they take on terms and conditions with their social media provider, they've already provided that consent. So you should just assume that you have provided consent, unless you're
Yeah.
you've really understood how these systems work and you manage to somehow close that consent out. Anything you do is available, and it's not just and let's take that to an extreme, and that extreme is China, of course, which is a big topic at the moment.
Yeah.
Um, for all sorts of reasons. But one of the things China has done is created something called social scoring, and
Mhm.
social scoring is an extension of credit scoring. So that obviously the Chinese government, as you all know, um, uh, is monitors extensively monitors social media channels in China,
Yeah.
and they have worked with some of the large social media companies in China to create a social score. And the social score, and there's a great Wired article, you can Google it and find it on this. And there's a fantastic book written by a lady called Rachel Boson. And you, what they do is they take the concepts of credit scoring, which is all the things we talked about just now, how you interact on Facebook, who you talk to on Facebook, what time you make calls, where you are geolocated, all these things. And they will create a score. That score, where we were talking earlier, for alternative credit can be used to provide a credit score. But they will also then extrapolate, for example, what you say on Twitter and what you say on Facebook and what you say, or the equivalent WeChat. And they will extrapolate that to what's called a social score. So, for example, if you are critical of the government, you will get a negative point against your social score. If you do things which are not in the interests of society, they will give you a negative. And then this score exists for all Chinese. And if you're below a certain score, you start to lose the ability to access certain services. So
Mhm.
below a certain score, you're not allowed to use fly. You're not allowed to fly within China. Or below a certain score, you're not allowed to fly internationally. Below another score, you're not allowed to fly within China. Below a certain score, you can't even take a train. Below a certain score, you're barred access from dating apps, which means you can't find a partner. I mean, it's a very, very, I mean, when you look at it and we think about it, it's something that's completely alien to us, and it's the extension of the social score. And by the way, what happened or through the pandemic in certain parts of China, including Wuhan, was this idea of the phones giving you a green, amber, and red signal. So the green means you can move around freely. The amber means there's certain things you're restricted from doing. The red means you can't leave your house. This is actually a further extension of essentially the same system. It's a very big data AI driven system which decides, what you can and what you can do based on all this data collection. And I bring you all that example because let's not make a mistake about it. The Chinese may be doing it and maybe doing it very overtly in China. The rest of
Yeah.
the world is doing it, but they do it covertly. So when you read
Okay.
about Cambridge Analytica and the
Yeah.
US election, when you
Yeah.
read about the misuse of Facebook data, when you use about corporations checking on people they're about to hire by looking at their social media feeds and for example, if they don't agree with the politics of that person or they don't agree with what they say, they use that, but they'll never tell you that they've used that. And the reality is that data is then people will use that data. And so to answer your question, and sorry in a very long about manner, is of course you have to be absolutely careful about what you post online and how you interact online because all of that is very visible. And some of us, are actually quite averse to having any sort of personal interaction online for that reason. We'll use it for business interaction, sure, but
Yeah.
for personal interaction, we're much more cautious as a result.
Okay. Thank you, Udayan. So, ladies and gentlemen, so that's the power of social media. So it can whatever you are typing, whatever you're using social media can be interpreted for your credit rating and scoring, etc. So I continue to discuss with Mr. Goyal. Meanwhile, we're almost approaching the halfway mark. So please put in your questions in the Q&A box, or if you want to ask a question directly to Mr. Goyal, you can even raise your hands and the digital team will facilitate asking you the question. So let's talk about identity management, Udayan. How is credit distribution changing due to the paradigm shift in identity management from what you know to what you have and what you are? Maybe some of it you already answered, briefly with this example that you gave. But is it something that you would want to elaborate here further on identity management?
Yeah, look, and I think again, over the past month, weeks, we've talked a lot about identity.
Yes.
Identity is very much at the cornerstone of getting a financial transaction done, or to be frank with you, any sort of transaction. The reason behind that is you must authenticate the person on the other end of the transaction to make sure that is the person that you are transacting with, because identity fraud and doing it with somebody else is, by the way, no different from 15 years ago, somebody going into the bank with a forged check. It's the same thing. They basically have appropriated your identity, signed the check, and tried to do something fraudulent. It's the same. And in the digital world, it's the same. The analogy is the same. The sophistication is very different. We talked actually, you may recall, about the Bangladeshi central bank fraud, where
Yes. Yeah.
almost $100 million was appropriated, and that was a usage of identity. So identity is very important. Now, we also talked previously that, like in India, Aadhaar solves the identity situation in the best way, which is to take something which is very difficult to forge, which is who we are, to your point, from a biometric perspective. So facial scan, retinal scan, fingerprints, these things, but that are very, very difficult to replicate, and use that to authenticate somebody's identity. That's probably the best way to do it because it's very, very hard. It's not impossible, but it's very, very hard and the resources you need to create identity fraud through those systems is difficult. However, in most countries, that's going to be a tough sell. We may move ultimately globally to biometrics, but many countries have significant issues with biometrics because of the same reason that we just heard from what's happening in China. In China, by the way, there are cameras everywhere, and through facial recognition, most people will know, or the government and certainly the authorities will know where you are, what you've done, and where you've gone. Then that's how they've used the green, amber, red system for the COVID, because they can track where people are through facial recognition. That kind of invasion of privacy in most countries is very, very difficult to implement. And so people don't like the idea of using biometrics. They don't like the idea of using facial scans. They don't like the idea of using that information. And so you need to find a proxy. And the way you
Yeah.
think about the proxy is to use your digital fingerprint in ways that are creative. So the initial use of this was obviously we're all familiar with passwords. You had a single password entry system. Now you have something called two-factor authentication, where you
Yeah.
use, let's say, an SMS to your phone, and it's known that the phone belongs to you. But you have spoofing of phones now. You have phishing. You have all
Yeah.
sorts of things that allow you to get around that. So we get more and more sophisticated, and we're now starting to get into this multiple factor identity management system, not dual factor. So
Yeah.
we can now think about geolocating your phone, doing the second factor authentication, having a password, looking at which network you're currently using your phone on, looking at your previous location relative to where that is. You can keep going on and on. And the more factors you add, the more secure you are in the knowledge that this is the right person. And so we are moving into a paradigm shift in identity management, which is starting to look at a multifactorial risk-based approach.
Yeah.
Everything in life, as you know, follows largely what we call a normal distribution curve.
Yeah.
And the further on the right you move with the normal distribution curve, and the shorter you make these standard deviations, the better it is for you to be able to actually understand that this person is who he or she says they are using the multiple factors. And so what we're really doing is trying to move statistically to a 99.99% confidence level around identity and use as many factors as you can. And so,
Yeah.
interestingly enough, if I think about where the next, a lot of growth in the future in terms of opportunities, we've touched on this before. One area is cybersecurity, and within cybersecurity is identity management, because identity management is at the core of cybersecurity. If you
Yeah.
can identify who that person is, and then grant them access, you avoid the ability for somebody to breach and come in into that network and keep that network secure. So cybersecurity is a very clear area of this, and of course, all of this is both augmented, and you create extra risk because we move everything onto the cloud, and the cloud being a very important enabler of everything that we've talked about. So this idea of identity management, so the concept of what you know was your first factor, right? It's your password. You check
Yes.
that the person's knowledge and what they've put on the database. What you have is the idea of biometrics and some of the other things that we've talked about. What you are is this multifactorial approach. It's multifactorial because actually, as AI gets more sophisticated, for example, we're talking to each other here. If AI could get sophisticated, because AI could have measured my mannerisms and the way I talk and the way I interact from previous interactions, use all of that through machine learning algorithms, and then apply that here and say, well, actually, that is Udayan Goyal, so for the reasons because the interaction is the same. And so
Yeah.
we really move into this sophisticated world.
Okay. Excellent. I think that was beautifully explained by you, sir. That's nice. So it's getting more and more interesting, and this multi-factor authentication is, I think, the next perhaps the next dramatic shift that's going to happen, where we are used to perhaps a dual factor authentication, but it's just not that. It's going to be many more things that are coming, and that's what Udayan is talking. And statistically, we are going to be monitored, perhaps, and so we are seeing very interesting times coming to identify what you know, what you have, and what you are. So this is the key factors for the identification management. Thank you, Udayan. So I have the first query coming your way now, Udayan. It's from Tiag. It says, could you tell us about the role and relevance of credit rating companies? Recently, credit rating companies have made professional compromises in large infrastructure company scam. Your view on their grievances?
I'm presuming you're referring to data breaches. So I think which is an enormous issue in identity management, because going back to our discussion just a second ago, one of the things we talked about around data is what you know And what
Yeah.
you know is a lot of the data that sits in some of these, let's say your Facebook login or whatever it is. If that data is breached, then people can use that data to effectively do identity theft. And from identity theft, you can do things like financial transactions.
Yeah.
The large credit agencies have both benefited from this and also have been part of the problem, because if you use very specific types of data and you don't move into a multifactorial approach for risk management, then what happens is the minute that data is stolen, it's as if somebody went into your safety deposit box and took your things. It's exactly the same. It's very hard to prevent it. So I think that as a result of this, a lot of companies are strengthening their approach to holding data, especially in this world of cloud. And secondly, are really rethinking access of data and how you authenticate people from that identity perspective. So I would say this is kind of where we are in that, and I think we'll continue to see data breaches. That's a fact of life. But what we'd also continue to see is a greater sophistication for people to manage identity and manage access. I think that's what we'll see in the future.
Excellent. Thanks, Udayan. Thanks, Tyag, for the question. I have another query for you coming from Mr. Prabhakar Kaza. He says, or rather, he asked a question. In many cases, social media profile differs dramatically from their payment ethics and compliance to lending discipline. While this kind of approach might boost the profile of social media pundits, does this negate credit scoring mechanisms of the banks? Any thoughts on this?
Well, I think there's an assumption in that question. The assumption in that question is that you somehow can correlate how somebody behaves online to how good a credit they are now. And the assumption there is that some sort of good behavior that we consider good behavior would equal to credit. The way the data science works is a little bit different. The way the data science works is to say, and by the way, this is real, this is how a lot of these companies have done it, is let me lend, and I know of a company that did this, let me lend $100 to 100,000 people, right? I'm going to lend $100 to 100,000 people within this population, within this country. Then what I'm going to do is I'm going to monitor their repayment behavior. And at the same time, I'm going to collect every piece of data from their social profile and from other profiles that I can. So then I have a database. This particular company actually is a pioneer. It's called Creditech. Many years ago, I think, was one of the first companies to do this. We'll collect 50,000 points of data. We'll collect the repayment behavior. The repayment behavior then shows that there'll be a cohort of people who've defaulted. There'll be a cohort of people who've stayed current. There'll be a cohort of people who've even been better than current and repaid their loan early, for example. You can map that on a loss given default curve, right? You can map that, which is a traditional curve that banks use. And you can map that on the probability of loss, which are the two things you need. Okay, so you can map that, and then you can map the 50,000 data points against it. What you're looking for is strong correlations between a higher propensity to pay, so probability of default, right? So a lower probability of default and a lower loss given default. You're mapping that. As you map that, what you end up getting is certain data points which are highly correlated to those behaviors. And that's what you use. And so and the point I'm trying to make here is that if the system is set up correctly, you do not use judgment on what is good and bad. You're literally doing correlations between what is the outcome and what is the data point, and then using that correlation to make a judgment. And so that there's no good or bad or how a person behaves and whether you're a social media pundit or you're not, all of that's irrelevant. What you're doing is you're mapping these behaviors against the outcomes. Does that make bank scoring models irrelevant? No, but it makes them, frankly, legacy. because now you're moving from something that essentially uses static data, because bank scoring models largely use static data, to something that's using real-time dynamic data. And behavior and propensity behavior is not something that you figure out once and it'll be the same. It's constantly changing. And so your ability to use dynamic data is important. Now, this is very important. We When we're having this discussion, we're making an assumption in our mind. And the assumption in our mind is that this is for personal credit. But this has just as much relevance for SME credit in particular, but any sort of credit, because you want to move to a dynamic way of looking at data. So one of the big game changers around the world, I talked a little earlier about this, is cloud. We have something called the cloud. Where we can store data in the cloud and it's easily accessible anywhere through the internet, right?
Right.
This is very important because one of the big game changers for SMEs and for companies has been to move accounting to the cloud.
Yeah.
As you move accounting to the cloud, your company data is a little bit like your social data sits in the cloud. Companies, in inverted commas, social data, which is really their accounting data because they don't interact like that, also sits in the cloud. And once it sits in the cloud, your ability to access that data and to make credit assessments on that data changes. And so you have a lot of companies like Cabbage in the US, iWalker in the UK, others that started to access small company SME company data in the cloud and start to give them credit on the back of that data. The second aspect of this, which is very important, is that it also rules out a lot of fraud that banks have around company fraud, around credit. One of the best ways, or one of the most well-known ways that companies will use to effectively change their credit fraudulently is through revaluation of invoices. So one of the big things that a bank will look at for in terms of a company's credit risk will look at the payables and receivables of the bank, right?
Yes.
And in particular, they look at the receivables and they look at the aging of the receivables. There's a big issue with a company when the gap between the payables and the receivables starts to become wider and wider, and particularly around the receivables, which means you are not getting paid on time for your services. You're getting paid later and later. And the later and later you get paid, you start to get into a cash flow crunch because you have a working capital issue, which then has a huge bearing on your credit. The way a company will get around this is let's say they have an invoice that's unpaid for 180 days. What they'll do is they'll go into their system and they'll cancel that invoice and reissue it. And if you reissue the invoice, the 180-day that wasn't paid suddenly becomes 0 days that hasn't been paid and doesn't get flagged anymore. Now, when you had an accounting system that was either manual on book entry in an office, or you had it on a server sitting in an office, you could do that. And it would be very hard for somebody to find out, unless they went into serious forensical analysis, that people had been revaluing the invoices. In a cloud-based accounting system, the minute you revalue the invoice, there is a timestamp of an action that's happened on that system. Yeah. And therefore, anybody who has access to that data can immediately say that gets flagged up immediately. So assuming the system is set up correctly, it's almost impossible for SMEs or companies to start to play around with this accounting fraud. And there's been a lot of accounting fraud that's been going on right now globally, most recently with a company called Wirecard that people may have been reading about. These kinds of things are very hard to do once you move everything up to the cloud and you start to have that sort of a system in place. So this is, so you need to start to really think about one is the opportunity set that this provides for banks, because banks moving into this kind of new age of data and taking away some of this legacy analysis is huge. The second thing is a lot of this allows you to automate your credit processes. And so bank legacy credit processes are highly manual. And that's one of the reasons that banks don't like to make small loans, because the cost of administering and actually giving out a small loan is as much as giving out a big loan. So many banks will only focus on large corporates. They don't want to be in the SME space because the cost base doesn't allow them to do that. The minute you start to use these systems and automation to do it, you start to get a much more scalable enterprise, and therefore you can do smaller loans at profitable levels. And so I would say that, this is kind of the way I think about where the bank systems are relative to some of these new alternative credit systems.
Excellent. Thanks, Prabhakar. I hope you got the answer from Udayan. Another query from Praveen Sekar. He says he's assuming, payment infrastructure is today still batch processing is the first assumption that he makes. How do you see payment infrastructure in the disbursement of credits, execution of transactions for near real-time and real-time execution, given that our payment infrastructure is still batch processing?
Well, firstly, I think payment infrastructure is moving quickly towards real time. When we talked about that, I think a couple of weeks ago, when we talked about real time payments, and we talk about the future of payments. So I think every country is very quickly moving to real time. The concept of batch is dropping very, very fast. So how does payment infrastructure fit into credit infrastructure? Obviously, if you can do real-time credit decisioning, you can also do real-time disbursement of credit. And that's where they fit together. So the idea is that and this is what came up 5, 10, 15 years ago with this concept of payday loans, which now has a very bad, nefarious association with it because of users' interest rates and other things. But there was a genuine need for people who, earn week by week or earn day by day, who suddenly get a bill and need to pay it and need the credit immediately. So that, companies came up to be able to give them that credit immediately, which allowed them to pay the bills. And, we talked about the farmer in the inclusion discussion last week. And, it's like the farmer's child is ill and they suddenly need money. This allows them to get that money without having to go to the money lender and, then be indentured for the rest of their lives to the local money lender. So, these have real, allows you to do, and so you need the disbursement to be real too, because there's no point getting in an in-principle decision for credit and then not being able to get access to the money. And so I think the infrastructure therefore follows that, and that's part of the reason I think we've ended up with some of this real-time payments infrastructure. And I think this goes back to the discussion we had a few weeks ago, where the future of payments is very much related to value-added services, because the core payment will never make money. But the number one value-added service that's going to make money is always going to be credit, because it's the highest return product from that perspective. And when I talk about highest return, I don't mean risk-adjusted return, because that's a whole different discussion. I mean the highest absolute value return, so in terms of revenues. So if you're going to build revenues, that's the way you do it. Of course, you have to manage the risk appropriately, etc. So you have to think about that. And so I think that's why a lot of payment networks, so if you look at Alipay or Alibaba, Ant Financial, all of these large, even Facebook now, and Apple has got the Apple Card, all of them are getting into credit. And they're all getting into credit, not directly with partnership, that's a business model point, but they're getting into credit because that's the way to monetize an efficient network, right? Whether it's a payment network or in fact a customer acquisition network. And so that's the convergence that we'll see.
Okay, thanks, Udayan. Thanks, Praveen, for asking an interesting question. So, Udayan, there are three things that are happening. One is the demographic shifts. Second is the disruptive technology advancements that are happening. And of course, the current crisis that we are all into. How are these two for the expansion of, how are they helping? Or is there anything that's happening in the expansion of credit products? And can you give some examples of innovative credit products launched by banks or neobanks or other financial institutions?
So demographic shifts, you have to separate developed markets from emerging markets. Developed markets are largely having an aging population. And so the demographics are very much around an inverted pyramid. That's the way developed markets are going. Developing markets are the opposite. They are a pyramidal structure where you have, especially in places like Africa, where the younger population is greater than the older population. That creates a fertile ground for giving young people or younger people access to credit products, because they have the greatest need because of where they are in their life cycle. They're in capital generation, and in order to generate capital, they need capital. This is the point that we made earlier. So that allows them to do that. So whereas in developed markets, it's more the savings base that is getting increased, etc. So that's kind of the demographic shift. The disruptive technology advancement that you talk about, that we've talked about earlier. It's the use of big data, the use of predictive analytics, the use of machine learning, a lot of that. So there's a lot of basically there's a lot of work that's being done, and that's disruptive. It's disruptive because we are moving away from traditional sources of data into these alternative sources of data, and we can use that to automatically and accurately predict a range of highly sensitive personal attributes, including the ability to pay, propensity to
Yeah.
pay. But you can do a bunch of other things too, which are not so great, like your political views, personality traits, intelligence, happiness. There are algorithms that allow you to look at all of this. And that's why you read about Cambridge Analytica and elections, and that's how this was used. So you have that's the disruptive technology. And
Yeah.
how does the current crisis lead to expansion of well, what the current crisis is doing is it's accelerating the digitization of everything in the world.
Yeah.
And as you
Absolutely.
accelerate the digitization of everything in the world, these sorts of alternative data sources proliferate because you store more stuff digitally. And so you have
Yeah.
access to more of that data. And if you have access to more of that data, you can analyze the data and you can provide credit on the back of that data. So you have, that's how we're going. So I think you'll have a massive proliferation of alternative data, and banks and neobanks will, as we say, start to embrace it. Now, there are lots of examples of banks and neobanks doing this. I mean, I've been an investor in a number of neobanks, but one of the neobanks I invested in is a bank called Fido Bank, which was based in Germany. And Fido was one of the first banks in the world to be able to use a lot of what we talked about, this alternative source of data and the digital data and people's behavior and all these things to offer, real-time loans to their customers. So if a customer needed to do a loan for a week because they needed to pay bills, they would basically could just press a button on your app and you'd get the money immediately in your account. The same thing with Moven, which is another investment made in New York. And again, it would be very much the same. You could press a button and get an immediate small loan and then repay that loan for a fee and etc. So there are lots of examples. The more sophisticated example we talked about a few weeks ago is CBA, Commercial Bank of Australia. They've created an embedded mortgage product where
Mhm.
you have an app and you go and see a nice house on the street that's for sale, and you either take a picture of the house or put it in your app, and immediately they'll do all the work and they'll give you a mortgage offer on the back of it. And that's an enormous use of big data that are able to provide you that service. And that's a great combination of the use of big data and this concept of contextual embedded finance that we've talked about. And as we move into more contextual embedded finance, which we've talked about extensively previously, these sorts of uses of big data and these sorts of innovative credit will proliferate. So whether it's you are about to go into a toll road and through the smart city infrastructure using the sensor data that's going to automatically deduct the toll and your balance may be zero, and so it'll automatically understand that you're a good credit and it'll give you that short-term credit for a small fee. That's the same thing. It's just in a much smaller scale. And we can see that across the entire value chain and how you do it. So this is, I think, the way we'll see it.
Yeah. Thank you. Yeah, you did mention about the CBA last time, and I think maybe, but this is fantastic, right? Participants, you click a photograph of a house you want to buy, and very soon you'll get a mortgage offer, uh, which is like unimaginative earlier, and that's what big data does. So let's go into the other part of the emergence of new credit access points changing the credit landscape. The CBA is perhaps one of the examples. How banks should respond to the deconstruction of the lending value chain, which has been controlled by them.
We've talked about this extensively as I think previously around the business model,
Yes.
the business model of financial services and the business model of banking. So if you recall the General Motors example I used previously,
Yes.
GM at one point was the world's largest car company. Today, I think it's Tesla. And GM used to be a fully vertically integrated institution. So they would take bauxite, convert it into aluminum, or take steel, convert iron ore, convert it into steel, press the steel, build everything. Today, car companies are just like Apple. There are design companies and sales
Yeah.
companies and marketing companies. Everything else is outsourced. They maybe do the assembly sometimes, but every part in the car is outsourced to another manufacturer, and et cetera, et cetera. So the value chain is completely broken up. Banks have also broken up the value chain now because you can because of wholesale markets, assets and liabilities can be sit in different institutions. There was a time when assets and liabilities had to stay in the same institution. So now you essentially, banks as regulated institutions are largely repositories of liabilities. They take bank deposits, which are then typically guaranteed by some form of collective scheme or the government. And then on the other side, they used to try and source loans to lend that money out and then to make the spread and to make some fees on it. Today, because of this proliferation of these new credit access points, which are essentially these neo credit companies that are able to assess credit much more efficiently, provide that credit much more efficiently, even in lots of companies in India, neo growth, I can think of many, many companies that do that in all sorts of innovative ways, which have formed up the NBFC sector. They've proven that they are much more efficient in sourcing assets. And they can get the liabilities when there's an efficient functioning wholesale market, because the liabilities are available from the bank through commercial paper and bank loans into that entity. And so there you've disintermediated the value chain, where one person is doing the distribution of the assets, and another person is actually doing the distribution of the liabilities. And then they're connecting in between through that wholesale market, and also through APIs on the data side, right, which we've talked about extensively. And this has been the stratification of the lending value chain, or the stratification of the banking value chain, so to speak. And so, as we said before, I think banks, financial services companies that are regulated are going to largely have to be wholesale providers of credit to the specialists who then distribute it to the end customer, because they are the specialists who understand that particular niche. So whether it's school loans, which I know there are niche providers in India who do, or whether it's merchant cash advance financing, where there are lots of niche providers, or whether it's SME secured loans or SME unsecured loans, all these things. And then banks will essentially lend into each of these companies through, and that's in a functioning market. Of course, we have issues right now in India in particular and other countries where it's not a functioning market, because I think the central bank doesn't treat those non-banking financial providers in the same way they treat banks from a liquidity perspective. And we need to obviously fix that. But once we fix that, I think you get very interesting opportunities. So that stratification will continue to happen, and I completely see it. And what that means is that if you're a subscale bank, I think you won't exist, like we discussed last week. If you're subscale in any way, then essentially you need to think about merging with a larger institution and creating scale.
Okay. So I have another query from Mr. Prabhu, and he talks about the Indian environment. What's your view on the information thrown by real-time payment systems being used in real-time credit decisioning in banks and financial companies? He says, he adds, I think at the moment it is not being done anywhere, especially in Indian banks, due to the existence of silos you have used.
Yeah, I mean, look, real-time information from payment networks, so to speak, is interesting information, but I don't think is the information that's critical to a credit decisioning process. I think it's helpful. By the way, that information ultimately becomes available because it forms part of the transaction repository of each person. So as it becomes a part of the transaction repository of each person, you can access that, and you can access that to make some sort of decisioning. I think the silo point is more about data interchange and how it works with the banks. I think, as we've talked about open banking and Payment Service Directive 2 previously, as regulation basically says that data must flow between these different silos, I think the data silo point gets taken away, and it will get taken away. So I think this information over time will become available ubiquitously through APIs and through the regulatory push.
Okay. Another query has come from the YouTube. He says, how does credit scoring work? A consumer's credit worthiness keeps changing maybe on a day-to-day basis? How do organizations keep tab of these changes?
Well, this comes back, KK, to what we talked earlier, which is dynamic versus static data analysis, right? So banks are largely focused, or legacy banks are largely focused on static data analysis. So that's where they take a certain point in time and they base the decision on that certain point of time. It's not dynamic. Or the whole point about the alternative data sources and alternative credit decisioning that we've talked about is that it's very dynamic. And so actually real-time changes in behavior and real-time changes in the data that's feeding into that changes the credit real-time, or the credit decisioning and actually the credit assessment real-time. And that's the beauty of having all that data in the cloud and all new data constantly getting into the cloud. So I think that's the difference. So I think we are moving towards real-time and we are moving towards dynamic.
Okay. So one important aspect of credit is risk management in financial institutions. What changes are expected? Will we start seeing use of much more extensively artificial intelligence and blockchain, which have far-reaching consequences in the way risk is looked at?
Yeah, we certainly will see the use of AI. I talked about earlier, AI and machine learning is very much at the cornerstone of alternative big data, or alternative use of credit, and alternative assessment of credit using big data. So there are lots and lots and lots of companies that's now specialized in this, and a lot of banks are now starting to implement this. They have to, and so they're starting to implement these systems. They're starting to implement AI in a major way. They're starting to implement machine learning in a major way. You have to be very careful with machine learning and AI because they tend to amplify biases. So let me give you an example. If you let an AI system do a credit assessment of Mumbai, for example, or any city, what will happen is they will say, after you give them all the data, you give them a day and you come back and now you say to them, who should I lend to and who shouldn't I lend to? Well, it won't be a huge surprise that it'll say, you should only lend to the richest area, I don't know, Malabar Hill, and you should not lend to any other part of Bombay if you ask it for a geographical demarcation. But that's not a good answer, right? For many reasons. One is there's some social implications of that, which is availability and democratization, etc. The other thing is you can't just risk score people like that, because you'll end up in a situation where you're charging the people who can least afford it the most, because they're the riskiest by nature, right? So you need to somehow find a nice balance from a regulatory perspective, and you need to find a pooled situation where you're looking at it more in a pooled analysis and where you force certain. So it can never be AI and machine learning which is unsupervised. There needs to be a level of supervision there, and that level of supervision needs to be to address some of these parameters. But we're definitely going. Now, blockchain is, as I've talked to you before, blockchain is merely a technology. It's like, should I use an Apple computer to do my analysis? Or should I use a Windows computer? Blockchain is kind of a much more efficient way of automating things on the back end. It's a way of really doing more around. It has much more fundamental implications around. We talked about this before. Let's say ownership of assets, because then you can irrevocability. It's about, there's a lot of identity can be solved using blockchain. Interesting, but the fundamental analysis that we're talking about is not really something that can change fundamentally with the use of blockchain.
Yeah, correct. Is social media channels used for determining credit worthiness? I think we have already discussed that. You have mentioned about how social media, people are keeping a tab of social media. So obviously that's part of it. Let's look at credit card companies over there. Now, credit card companies, credit card agencies, banks have massive amount of consumer data. Is big data and such other technologies used to mine the data securely?
I think the security point, if the point is around security, we talked about the security point. The security point is it's all about data security, how to secure data networks, authentication, identity, all of these points, So the security point is very much something that we've dealt with. Credit card companies mining data, they're going to use the same data that we've talked about before. It's going to be exactly the same.
Okay. So we are at the end of the hour. If you don't mind, I have just one more query, Udayan.
Sure.
As the banks get their act together on using alternative data for credit origination and decision making, wouldn't the niche NBFCs themselves get intermediated?
No, I don't believe so, because I don't think the banks can ever be as efficient as a niche NBFC. I think if you're a niche NBFC and you specialize in a particular area, you'll always be good at it. It's like, to use an analogy, it's like food. And if it's like food I like to use the example of Japan, where Japan has the best food in the world. That's because each chef only specializes in one little thing. So you have a tempura chef, and that chef will make the greatest tempura in the world. Or you have a sushi chef. And so when you go to restaurants in Tokyo, you don't go to a restaurant where you buy everything. You go to a sushi restaurant, you go to a tempura restaurant, you go to a teppanyaki restaurant, you go to, a yakitori restaurant. So each one will specialize on a specific type of food. By the way, that's similar in India with street food. You go to Chandni Chowk in Delhi, and you'll get, you'll have one guy who'll make the best biryani, and one guy who'll make the best aloo ki tikki, and one guy, and you know who that person is. And so you know by reputation who that person is, and you walk over and you go to the guy who sells you the best chaat, and that's the person you're buying. It's exactly the same. And it's going to be the same with NBFCs. NBFCs will specialize in a specific area. They'll be very good at it. And you don't have somebody you don't have somebody, think about yourself. You don't go to some restaurant where you eat everything and it's all amazing. That just doesn't exist, right? Everybody has a specialty. And so I think that's what you'll see.
Yes, thank you. Good, I mean, I don't know if it's good or bad to talk about chart and other times, at this times where we are just not able to get any of these. So thank you, Udayan. We had a wonderful time with you in terms of the information that we have given. So ladies and gentlemen, data is the most important thing, okay? And that's a game changer. With data, there's a lot of correlations being built. Your credit scoring, your credit worthiness, how much to lend, everything is based on data. So how you use data, how you use social media, how you use your smartphones are extremely important. What is clear for now, however, is that it looks promising for borrowers and will put greater control in the hands of consumers. It certainly is a brave new world we are stepping into with data as the game changer. Udayan, thank you very much for coming over. Another one of brilliant information, lots of thoughts. Thank you for coming, and look forward to seeing you again some other time. Thank you.
Thank you very much. Good to see you.
Bye-bye.